All right, our next guest says the current market dynamics have created significant valuation dislocations in value-oriented areas of the market. Joining us now is John Mowrey, CIO and Senior Portfolio Manager at NFJ Investment Group. John, good to see you.
Good to see you, Mike.
You know, we could have said this many times over the last couple of years about, the relative value in value type stocks. I wonder what you're picking up from the market's message recently, though, because it's fascinating. Monday, S&P down 1.5%. Most stocks were up. Yesterday, S&P was up 1% just about. Most stocks were down.
Yes.
Fitfully, the market is trying to see if it can make progress without the outright constant leadership of growth and tech.
Sometimes things can be changing below the surface and it's not fully seen yet. I'll make a couple observations. The first is that if you look at last year, very big year for the S&P 500, up 24%, particularly after a big year the year before, and after that drawdown in 2022 of 25%. Momentum as a factor was the single best factor last year that drove the market. The last time we saw momentum that outperformed by that magnitude was in 2000. And that did not spell a great, next chapter for some of those stocks that had been caught up in that. The other time that momentum had a very good performance was in 2007. And I pull out both those because they're both interesting observations. 2007 was the shift of the baton from value to growth. 2000 was growth to value. One more observation I'll make. If you look at what has occurred since the inflation reading July 11 of 2024, okay, value, all the value indexes, mid-value, large value, small value, they're all beating the S&P 500. The NASDAQ is actually trailing the S&P 500 since July. And NVIDIA, as an example of this, is up just 1%. So I do think there are some shifts below the surface that maybe are not fully picked up currently.
Those analogs, though, of 2007 and 2000 show you that those transitions didn't happen quietly, right? The S&P got cut in half both times.
Correct.
A lot of other things going on around the edges, too. But I wonder if you feel like we can do this, pass the baton at a full run.
Typically, you need to see volatility for the baton to be passed. And I will say that, what you saw on Monday, I think shocked everyone. It was kind of like sticking your finger in a socket and getting electrocuted. No one quite knows what to make of it. What I would say is that if AI catches a cold, there's going to be a lot of sneezing. And there's a lot of areas that are already deeply discounted. I think some differences with some of the previous leadership shifts is you already have a lot of valuation dislocation in the value areas, such as healthcare, such as materials, such as staples. These were all flat last year. These have done nothing in many cases for several years, and you are seeing positive earnings growth out of these areas. One area I'll also point to, which did do very well last year, which looks particularly attractive, is banks. Banks went through their recession in 2023, okay? And they've been re-rating. You now have a steepening yield curve. The Fed has pulled 100 basis points out. We'll see what they do today. The 10-year responded by moving higher. The 10-year went up 100 basis points. You have a steeper yield curve. That's good for banks. They have strong balance sheets. So I think there's a lot lining up in the camp for a dark horse play for value stocks as we look into the back. Well, we're just starting the year. The year's young, but it feels like a lot's already happened.
I would say, in terms of the idea that value is cheaper than it usually is compared to the overall index, in absolute terms, I mean, the S&P value index is at 18 times earnings. It's not like it's in aggregate value seems cheap objectively. It just is way less expensive, I guess, than the very largest growth stocks.
Well, I think it depends. That's one way of looking at it. If you look at price to book, which I think is another way to look, because you have a lot of cyclicals in value, which have earnings that tend to be more volatile based on the economy, like materials, for example, and energy. On price to book, you're back to the levels that you've not seen since 2000. So does that matter? It's an important point. It's something that I think investors should be taking note of. And I do think this is where diversification plays a big role in investors' portfolios. You don't need diversification. We have very concentrated leadership, but that's the time that you should be thinking the most about diversification. The other thing that I would point to is that if you look at, small value, I mean, that's trading at 12 times earnings. That's cheap. That's cheap historically. That's cheap absolute. And it is not participated. And you've got these companies out there, Mike, that are like $3 trillion. You got multiple of them. That's the entire market cap of the entire Russell 2000 value. And now you have a shift in the White House where you have potentially a more favorable backdrop for M&A. We've already seen multiple takeouts in the small cap arena. One just yesterday from Bain Capital with Surgery Partners.